stop what you're doing right now. Seriously, drop everything. If you were about to click another video, if you were checking your notifications, if you were mapping out the rest of your day, pause for a moment, because what you're about to hear is not a conspiracy theory. It's not a hazy prediction from a financial guru, and it is definitely not just more background noise from the markets. What I'm holding is almost ghost-like, an internal communication that was never meant to surface, never meant to leave closed rooms and private channels, a high-level internal directive originating from the center of one of the largest and most influential investment banks on the planet. This message comes from the deepest layers of the financial system. The name is clear, Morgan Stanley. And more importantly, it comes from the Bank S Commodities Trading Desk, the nerve center where billions of dollars shift position in seconds. This communication was circulated very recently, roughly 3 days ago, to a small and exclusive group of clients. Hedge funds, sovereign wealth funds, ultra-high net worth investors who sit at the very top of the global wealth pyramid. And buried inside this message are 3 words that, if you understand their meaning, should make your stomach tighten. Exit all positions. Take a moment and think about that wording. In high finance, words are never chosen casually. They're cut with the precision of a master diamond cutter. They didn't say reduce exposure. They didn't say rebalance the portfolio. They didn't say hedge against potential volatility. They said one thing, exit. In the language of Wall Street, that isn't advice. It's a warning. It's an evacuation order. It's the command you hear when a ship can no longer be saved, when a building is on fire and the structural supports are already beginning to fail. A firm responsible for managing trillions of dollars in client assets is signaling that it wants nothing to do with the silver market, and it has set a clear timeline to do it, by the end of the month. This is not a casual recommendation. It's an expression of institutional stress. It's the moment when the smartest people in the room realize they've been sitting on a mechanism that S already ticking, and their calculations are telling them the same thing, not weeks, not months, days. A very narrow window to get clear of the blast zone. I've seen this communication. I've confirmed its existence through multiple sources inside the institutional trading world. And what I am about to walk you through may be one of the most important financial signals you hear this year, possibly this decade. Because when a firm like Morgan Stanley steps back, it means their internal risk models are flagging something the public hasn't seen yet. This has the potential to reshape the structure of the precious metals market. And moments like this always produce the same result, a sharp divide between those who recognize the warning early and those left standing in the wreckage. Right now, you're standing at a decision point. You can dismiss this as exaggeration, another the sky is falling story. Or you can recognize the pattern. What happens behind closed doors on Wall Street often looks like rats leaving a sinking ship. Smart money moves first. Exit plans are already in place before the first drop of water hits the deck. In a moment, I'm going to show you what Morgan Stanley is seeing. I'll explain why they're moving so quickly. And most importantly, I will lay out what you should be thinking about before this process becomes visible to the wider public. Because once that happens, the exits may already be jammed. What's striking is how short this internal communication actually is, just 3 paragraphs. But every sentence lands like a precision strike. When you're instructing billion-dollar clients to unwind positions, there's no room for decorative language or marketing spin. The first paragraph focuses on the technical trigger. Due to extraordinary volatility, and this is the critical phrase, structural changes in the silver derivatives market, institutional clients are being advised to close all long and short positions. That includes COMEX silver futures, options on futures, and over-the-counter silver swaps. Structural change is one of Wall Street's quiet code words. It means the system is no longer behaving the way it's supposed to. When market structure breaks, the fundamental rules that hold everything together stop applying. It's like being told that the bridge you drive across every day has developed deep, invisible fractures, and engineers are no longer confident it can support even a single car. In that situation, you don't drive slower, you don't lighten the load, you shut the bridge down. The second paragraph sharpens the sense of urgency. The guidance applies to all position sizes and all expiration dates. And then comes a line that's hard to ignore. Prioritize orderly liquidation over price optimization. In plain language, that means this: losses on the way out are not the concern. Selling at an unfavorable price is not the concern. The only priority is closing positions while liquidity still exists, because whatever scenario is approaching at month end may be far worse than taking a hit today. And that month-end deadline isn't arbitrary. It isn't a calendar convenience. It's a mathematical wall. Based on Morgan Stanley's calculations, multiple forces are expected to converge at the same point. And when they do, holding any silver position could become exceptionally dangerous. At that stage, the question is no longer if something happens, but when. Then comes the third paragraph. This is the hardest, heaviest section of the entire message. This is where the bank makes it clear that it WIS, not just issuing a warning, it leading the retreat. The language is unambiguous. Morgan Stanley states that over the same time frame, it plans to reduce its own balance sheet exposure to silver to zero and will not accept any new silver-related business until further notice. Pause for a moment and really think about the weight of that statement. A global bank exists for one core reason: to generate fees. Every trade, every contract, every position is a revenue stream. When a bank says, "We're not taking new business," it's effectively lighting its own paycheck on fire. It's walking away from millions, potentially billions, in future income. Institutions only make that choice when the risk of staying in the market rises to an existential level. The conclusion here is brutally simple. Whatever profits the silver desk might generate are not worth the risk of the silver desk destabilizing the entire firm. Before we go any deeper, it's important to understand how a communication like this comes into existence. Banks do not wake up one morning and decide to frighten their clients. Every word in that document would have been scrutinized repeatedly by legal teams, compliance officers, and risk managers. In all likelihood, it went all the way up to the executive level, because telling clients to exit positions carries enormous legal liability. If the bank is wrong, if this warning causes unnecessary losses, the consequences are severe. Lawsuits follow, reputation erodes, major clients leave. That's precisely why Morgan Stanley putting this guidance in writing is such a powerful signal. Internally, the models are sounding alarms. The calculations have already been run. The bank has concluded that the risk of being wrong by warning clients is far smaller than the risk of staying silent. In other words, they see a meaningful probability of a serious disruption in the silver market before the month is over. Now let's talk about what they can see that you can't. Morgan Stanley's commodities trading desk operates from a vantage point few participants ever experience. They monitor real-time order flow on a scale retail investors can't imagine. They see what other major institutions are doing behind the scenes. They track the actual movement of physical metal because they are directly embedded in the supply chain. They're not reading headlines and guessing. They are physically moving millions of ounces of silver from one part of the world to another. And right now, their screens are lighting up red because 3 separate crises are unfolding simultaneously, and they are converging at the same moment. The first crisis is inventory depletion, and the numbers are genuinely alarming. Registered silver inventory at COMEX has fallen sharply, dropping below 32 million ounces. To the average person, 32 million sounds like a lot. In the context of global finance, it's barely a buffer. It's the lowest level seen in more than a decade. But what truly concerns Morgan Stanley isn't the absolute number. It is the speed of the decline. Just 6 weeks ago, registered inventory stood around 41 million ounces. That means roughly 9 million ounces vanished in a month and a half. On average, that we guess about 1.5 million ounces of physical silver leaving the vaults every single week. If you run the numbers at that pace, registered inventory hits zero in roughly 21 weeks. But markets don't move in straight lines. They accelerate. In the last 14 days alone, another 4 million ounces disappeared. If that accelerated rate continues, the possibility of empty vaults within 8 weeks is no longer theoretical. Skeptics are quick to point to the roughly 230 million ounces classified as eligible inventory. They argue that metal can simply be moved into the registered category if needed. But this is where institutional knowledge matters. Eligible metal does not belong to the exchange. It belongs to private institutions, wealthy families, and hedge funds using vaults for secure storage. They have no obligation to sell that metal. With physical silver premiums surging in places like Shanghai and London, why would those owners sell at paper prices on COMEX? They wouldn't, and they don't. That metal is effectively locked. It is not a backup supply. It is a private reserve, which means the only true buffer the system has is registered inventory, and that buffer is shrinking fast. The second crisis is the surge in delivery demands. To understand why this matters, you have to understand the core contradiction of the silver market. Historically, silver has been a paper-dominated market. For every single ounce of physical silver that actually exists, hundreds of ounces trade through futures and options contracts. The system has worked because roughly 95% of participants never intend to take delivery. They're speculating on price. When contracts expire, they roll them forward or settle in cash. But that ratio is starting to shift rapidly. Under normal conditions, only a tiny fraction of investors ever show up at the vault and say, "I want my silver." That fraction is no longer tiny. In the most recent delivery cycle, roughly 9% of open interest stood for physical delivery, nearly double the historical norm. Even more striking are the preliminary figures for the upcoming month. Some estimates suggest that 12 to 15% of contract holders may demand physical metal, and that's where the math becomes unforgiving. Now let OS walk through the math, because this is where the situation stops being theoretical and becomes brutally concrete. In the silver market today, there are roughly 160,000 open contracts. Each contract represents 5,000 ounces of silver. That means the paper market is carrying claims on approximately 800 million ounces of silver. If just 15% of those contract holders decide they want physical delivery, the exchange would need to provide 120 million ounces of real metal. But, as we've already established, the amount of silver actually sitting in registered vaults is closer to 32 million ounces. You cannot deliver 120 million ounces when you only have 32 million available. This isn't a matter of opinion, it isn't pessimism, it's a mathematical impossibility. So, what happens when the numbers stop working? The system freezes. The exchange cannot meet its delivery obligations and is forced to declare extraordinary measures. Buyers are told, "We don't have the metal, you'll be settled in cash instead." And in that exact moment, an illusion that has held for decades collapses. The paper price loses its meaning because everyone realizes the same thing at once. The contracts in circulation may not actually represent metal that exists. The third crisis, and arguably the most dangerous, is one almost no one in the media is talking about: counterparty risk. Beyond the public exchanges lies a massive shadow market for silver. Private, opaque, lightly reported. Estimates suggest that between 5 and 10 billion ounces of notional silver exposure exist in these off-exchange agreements. A significant portion of that exposure is short. In other words, large players have sold silver they do not actually own. As physical silver prices begin to detach from paper prices, those short positions come under pressure. Carrying them becomes more expensive. Margin requirements rise, liquidity tightens. Morgan Stanley can see this clearly because they sit at the center of the interbank credit system. They can see which institutions are suddenly scrambling for collateral. They can see who is drawing down emergency credit lines. And what they're seeing is this. Several major players in the silver market are facing a serious liquidity squeeze. In any interconnected system, there's always a weakest link. And if just one of those links fails to meet a margin call, the contagion spreads immediately. Global finance is tightly woven. If Bank A stumbles because of a silver short position, Bank B suddenly finds a hole in its balance sheet. It's a line of dominoes, and once the first one tips, the rest don't get a vote. Morgan Stanley has looked at that board and recognized that the first domino is already wobbling, and they have no interest in being in the room when it falls. That's why they're stepping back now. The objective is simple. When counterparty failures begin, they want to be holding cash, not exposure. These three crises are not unfolding in isolation. They are feeding into one another, creating what finance typically calls a feedback loop, but in this case, it's more accurately described as a destructive loop. Morgan Stanley's models show that once this process reaches a certain speed, it stops behaving linearly and starts accelerating exponentially. It begins with falling inventory. As vault levels drop, the market notices. Confidence erodes. People start thinking, if silver is becoming scarce, I should secure physical metal now. That thought alone increases delivery requests, which drains the vaults even faster. As inventory thins, banks that are short silver realize they're trapped. They can't source metal to cover their positions, so they rush into the market trying to buy it back. That buying pressure pushes prices higher. As prices rise, more investors move into silver to protect their purchasing power. That additional demand further depletes supply. At the same time, physical premiums begin to surge. And when premiums spike, they broadcast a clear message to the world. The paper price no longer reflects reality. That realization pushes even more participants out of paper markets and toward physical metal. The cycle feeds on itself faster and faster until the system reaches a point where it can no longer absorb the stress. According to Morgan Stanley's internal data, that acceleration phase has already begun. On their timeline, the window to exit before the system reaches its breaking point closes at the end of the month. This isn't a guess, it's a calculated threshold, the point at which system stress overwhelms available safeguards. There's another reason Morgan Stanley is moving so decisively: institutional memory. They've seen this before. In March of 1980, the Hunt brothers accumulated a massive physical silver position. Prices exploded from around $6 to nearly $50 an ounce. Large banks found themselves on the wrong side of the trade and were bleeding capital. Then, overnight, the exchange changed the rules. Trading was restricted to liquidation only. You could sell, but you could not buy. The price collapsed. The Hunts were destroyed. The banks survived. Morgan Stanley hasn't forgotten that lesson. They understand that when markets break, authorities intervene to protect the system. And when rules are rewritten, someone always gets sacrificed. This time, they don't intend to be that party. Think back to 2008. The institutions that moved first, the ones that unloaded mortgage-backed securities while liquidity still existed, survived. Those that waited, like Lehman Brothers, disappeared. Morgan Stanley itself nearly failed during that crisis. The lesson they carried forward was simple and unforgiving. When you recognize a systemic risk, you don't wait to be proven right. You exit. That lesson surfaced again in 2022 during the nickel market shock. A violent short squeeze sent nickel prices from around $20,000 to over $100,000 per ton in a matter of hours. Trading was halted. Then, something extraordinary happened. Billions of dollars in completed trades were retroactively canceled. Profits earned by participants on the correct side of the trade were effectively erased to stabilize the system and protect short sellers. The rules changed to preserve the structure. Morgan Stanley sees the same warning signs forming now, and they are acting before the rules change again. Morgan Stanley is seeing the same warning signs in silver today, and inevitably, they do not want to be the party left holding exposure in a scenario where trading is halted. When you recognize that a system is close to fracturing, staying at the table until the very last moment isn't bravery, it's gambling. So if Morgan Stanley sees this picture so clearly, why warn clients at all? The answer comes down to two core reasons: legal protection and strategic self-interest. First, there's the issue of duty. If the bank were to quietly unwind its own positions while clients absorbed billions in losses, the legal consequences would be severe. Issuing a formal internal warning creates a documented record that says, you were informed. It's a defensive mechanism, a way to protect the institution if things unravel. The second reason is more strategic. The bank wants a controlled withdrawal. If everyone rushed to sell in the same hour, the market would collapse instantly. By setting a timeline, specifically the end of the month, they spread the exit over time. Selling pressure is distributed, and the bank can unwind its own large positions without triggering an immediate breakdown. This isn't generosity. It's a calculated, cold-blooded retreat. And this process gives you a rare look behind the curtain. Most retail investors glance at their trading screens, see silver hovering around $30, and assume everything is fine. Meanwhile, the largest players have already started moving toward the door. By the time the broader public realizes a collapse is unfolding, the exit will already be crowded. When Morgan Stanley's withdrawal truly accelerates, it won't happen quietly. A directive to exit all positions creates pressure in both directions. Short positions must be closed, which requires buying. That produces sudden, violent price spikes. Long positions must be closed through selling, which produces sharp drops. These rapid swings trigger stop-loss orders across the market, pulling thousands of retail traders into the chaos. And remember the instruction: prioritize liquidation, not price. For Morgan Stanley, the best possible price is no longer the priority. What matters is that the positions are closed. When the largest player in the room stops caring about price, market structure begins to dissolve. At that stage, you start seeing spreads that make no sense. A bid at $27 and an ask at $32. $5 gaps where liquidity used to exist. That's a sign market makers have effectively stepped back. Liquidity evaporates. In finance, this is known as a liquidity death spiral, and we may be only weeks away from it. As the end of the month approaches, another phenomenon becomes visible: divergence. Under normal conditions, paper silver and physical silver move together, but during systemic stress, that relationship breaks. Institutions liquidate paper exposure, pushing spot prices down. At the same time, physical silver becomes scarce. Holders see the chaos and refuse to sell. The result is strange, but entirely possible: an official price of $30, while a dealer asks $50 for a physical coin. This is why Morgan Stanley is telling clients to exit everything. They understand that price itself may soon become an illusion. If you're holding a paper contract, what you really hold is a promise, and promises don't always survive structural failure. So why is the end of the month such a hard internal line? Because it's a moment of full exposure. On the final day of the month, banks must mark every position to market. Gains and losses are formally recorded on balance sheets. Those numbers don't stay internal. They're reviewed by central banks and global regulators. If a firm is holding large silver positions that suddenly show catastrophic losses, capital ratios come under pressure. If those ratios fall too far, credit ratings are at risk. That's why Morgan Stanley wants its balance sheet clean before month end. They want to be able to say, unequivocally, we have no exposure to a silver dislocation. And that's also why clients are being pushed in the same direction. When a major client fails, margin debt often lands back on the bank. By clearing the table now, the institution is insulating itself from what may be coming. Right now, you are living in the gap, the space between when smart money sees trouble coming and when the broader public actually feels it. Turn on financial news and what do you see? Interest rates, employment numbers, routine commentary. This is the illusion of normalcy. But beneath the surface, billion-dollar silver positions are being quietly unwound. Mainstream media rarely highlights this phase. Not because it's unimportant, but because the owners of those platforms are often connected to the same system. What they need is time. They need liquidity. They need participants to stay in place while exits are still possible. History shows the same pattern over and over. In every major financial collapse, the public narrative insists everything is fine, right up until the moment it clearly isn't. Morgan Stanley isn't waiting for headlines to catch up. They're not trusting sentiment. They're looking at the data, and the data suggests that the orderly phase of this market is already behind us. So the real question becomes this: what do you do with that information? The first step is changing how you think. You stop thinking like a gambler and start thinking like a risk manager. Step 1, clarify your exposure. Look at your portfolio carefully. Do you own silver? And more importantly, how do you own it? If your exposure sits inside an ETF or an unallocated account, what you're holding is not physical metal. It's a paper claim. In periods of structural stress, paper instruments are always the first to fail. You could wake up one morning to find that your silver ETF has been liquidated at a price dictated by the exchange, not by the market you thought you were participating in. Step 2, understand the conversion window. You may have roughly 3 weeks left, possibly less. The objective is to convert as much paper exposure as possible into physical possession. Yes, that comes with a cost. Right now, it might mean paying $10 over spot, but this is where institutional thinking matters. Institutions don't ask, what's cheapest today? They ask, what is certain? And certainty sounds like this: I would rather pay $40 for something real than $30 for a piece of paper that could be worth zero. Step 3, monitor the red line indicators. You need to become your own analyst. Check COMEX vault reports daily. Watch the registered inventory closely. If those levels begin to drop below 25 million ounces, the system enters the danger zone. Beyond that point, the probability of a delivery failure rises sharply. Step 4, prepare for two-way volatility. Paper prices will behave like a dying star, violent spikes followed by sudden collapses. When short positions are forced to cover, prices will surge. Don't celebrate. When long positions are liquidated, prices will fall hard. Don't panic. If you hold physical silver, stop obsessing over the spot price. The only price that truly matters is replacement cost, what it would take to buy that same silver again after you sold it. I know some of you are still skeptical. You're thinking, banks shift positions all the time. We've heard about a silver squeeze for years and nothing ever happens. That because the skeptic eyes trap, the belief that because something hasn't happened yet, it never will. But look around. The nickel market broke. Regional banks trembled. Entire segments of the financial system have already shown cracks. Silver remains one of the smallest and most heavily leveraged markets in the world. If Morgan Stanley's models are telling them to walk away from a profitable business line, the math has crossed a critical threshold. So ask yourself a simple question. What's the risk of following their lead? If you buy physical silver and nothing dramatic happens, you still own a tangible asset. But if Morgan Stanley is right, and you remain exposed to paper claims, the downside is total. At this point, the risk-reward equation is no longer complicated. When the smartest people in the room start moving toward the door, you don't stay seated. This internal communication is only the trigger. There's a much broader geopolitical pressure building beneath the surface. For decades, Western financial systems used paper silver markets to suppress price signals, but the world has shifted. In the East, particularly China and India, demand for physical silver is relentless. Smart traders buy silver at discounted paper prices in New York and move it to markets where real pricing exists. That flow creates a vacuum, quietly draining COMEX vaults. And silver is no longer just an investment asset. It's a critical industrial input. Solar panels, electric vehicles, advanced electronics, and defense technologies all depend on it. On a global scale, we're facing a structural supply deficit. You can print trillions of paper contracts, but you cannot print a single ounce of silver. That's why Morgan Stanley is stepping back. They don't want to be standing in the middle of a failed exchange. We are entering the final days of the old silver market structure. You're going to see physical supply move from in stock to delayed to sold out. This is the last phase of the countdown. If you're holding paper silver, you have a decision to make. If you're holding physical silver, you're already in the lifeboat. Don't let paper volatility shake you out of real assets. Transitions like this shift purchasing power. The people who make it through holding tangible value tend to be the ones who control options on the other side. Morgan Stanley has effectively given you a small time advantage, a head start before awareness spreads. In financial markets, the difference between winners and losers is often nothing more than information. The exit door is still open, but the crowd is starting to move. Don't wait until movement turns into a stampede. This isn't a surprise. It's the documented outcome of a stressed system. Morgan Stanley is out. Their clients are getting out. The question isn't what they're doing. The question is what you're going to do. The countdown has started. Use your time wisely. When the month ends, the paper bridge may be gone. And at that point, the only thing that will matter is what you can actually hold in your hands.